From Markey Insurance today, we have Geoff Donegans from the Markey Financial Services here to discuss income protection insurance. Geoff is an authorised representative of Millennium 3 Financial Services Proprietary Limited, and as usual, this discussion refers to general advice only, and individuals should seek personal advice from an appropriate source before acting on any of the comments made. Good afternoon to you, Geoff.
Good afternoon, Julian.
I think it was a mouthful to start off with there.
But legalities.
Geoff, what is income protection insurance? Well, why is it so important?
Well, Julian, when it comes to insurances, people are very quick to insure their house, their car and their boat, but they don't think of their biggest asset of all, and that asset is their ability to earn an income. Without an income, people are unable to meet their daily living expenses, and without an income, their family will suffer. This is true for both employees, self-employed workers as well. Sick leave and holiday pay are finite in length, and self-employed people don't even have that usually. So basically, income protection is a means of providing for both yourself and your family if an illness or injury prevents you from working.
So how does income protection work?
It's very straightforward, Julian. If you suffer an illness or an injury and you're unable to work according to your doctor, you're eligible to make a claim. And like other insurances, it has an excess, but in this case it's called a waiting period, and you can be on claim until you're able to return to work, you reach the end of your benefit period, or in the unfortunate event, you die. It's whichever occurs first.
So how much could you insure for?
Julian, you can insure for between 75 and 80% of your income, and most policies will provide some additional benefits for you if you need retraining or rehabilitation. The sweetest part of all is that usually the premiums are tax deductible, and you're normally covered 24 hours a day worldwide. Just
before I go on to the next question you've asked me, you mentioned self-employed people. Are they able to insure, because obviously their incomes vary a little bit, don't they?
Well, they vary a little bit, but if they're a sole trader or if they're in a partnership, they're not even entitled to workers' compensation.
Yeah.
So they have nothing.
But they can insure for income protection?
Income protection, yes, definitely.
Okay, so, the next question, can anybody get income protection, and how much does it cost?
Well, to get a full comprehensive policy, you have to apply for cover, and this involves completing an application, so the insurer can assess what cover you actually qualify for. This is based on your gender, your age, your smoking status, medical history, your occupation, your income, and also your pastimes. And then the premium's based on an assessment of all these factors, and it's then influenced by the waiting period that you choose and the benefit period. But typically, it can be between 1.5% and 2.5% of income, and that's before the tax deduction. And just to give you a bit of an example, if you're a 33-year-old non-smoking motor mechanic on, say, $60,000 a year, if you chose a 30-day wait and a benefit to age 65, the premium would be about $1,400 a year. Then you would claim a tax deduction on that premium.
So have you got any classic claim examples you could tell us about?
I sure have, and probably the closest one is my own. When I was 42, which was longer ago than I prefer to remember, I suffered a major heart attack. Now, I was unable to work for 6 months. I wasn't planning on having the heart attack, and if I hadn't taken my own advice, I would have been in a lot of trouble. I had a young family and a mortgage. Things would have been awkward, and having the income protection, I was able to recover without the financial stress that would have occurred.
And you're obviously back at work again today.
I've been back at work for
many years.
Many years, yes, without giving too much away, yeah. I've got another client that was a skydiver. She was diving in free fall, and unfortunately another skydiver clipped her on the way down. She broke her arm while she was in the air. Luckily she was able to land, but she was obviously unable to work, and this resulted in a claim for her. And I suppose just another one that springs to mind, we had a claim recently where a young client had locked himself out of his house, and being young, he decided to break a window and reach in. But unfortunately, he severed a tendon in doing so. He's a tradie. He was unable to work. Luckily, he had income protection until he could recover.
Just that point of the skydiver there, so that even if people take in dangerous activities, they're still covered in those?
It depends on the activities and when they took them up.
Okay.
Normally, if you are already doing skydiving, it would be an exclusion. But in this case, the client had the policy in force for a couple of years and she took up skydiving.
Okay.
And policies are guaranteed renewable, so once they're in place, they're there for as long as you wish to keep them.
Okay, so don't do anything dangerous until you've got the policy.
Well, that's reading between the lines, but yes.
Is there anything else you can offer to assist people in understanding income protection?
Well, I think the basic thing is to make sure that you get proper and appropriate personal advice. Read the product disclosure statement and make sure you understand what you're being offered.
Well, great. Well, thanks very much for your time again, Geoff, and we'll have Steve back in a couple of weeks.
He'll be back, and I'm sure he'll have something interesting up his sleeve.
Thank you. You have a good day.
Thanks very much, Julian.